Hey, Steven here from the Trading Channel, and I have a question for you. Have you ever felt like you were on the edge of a cliff? Like you were one false move away from completely blowing your trading account? If so, don't worry, you're not alone. I've been there too, and I know of plenty of traders that are there right now. And the reason for this is because of one very important skill that can either land you as another number in statistic of 95% of traders that either give up on trading or completely blow their accounts, or keep you out of becoming another number in that statistic. And what this one important skill is risk management. Now, a lot of traders tend to think that risk management is some super complicated subject, when in reality, you only need to know 3 things in order to master risk management. Number 1, you need to understand your own risk tolerance. Number 2, you need to understand and implement stop loss orders. And number 3, you need to understand how to calculate your position size very quickly. Now, in this video, I'm going to be teaching you how to do all 3 of those in the hopes that by the end of this video, you will have the ability to master risk management for yourself. So if that sounds good, go ahead and click that like button for me. Go ahead and subscribe if you're new to the channel, and I'll see you on the other side of the intro and disclaimer. Welcome back, and let's get started with number 1, which is risk tolerance. For the scope of this video, risk tolerance is going to refer to the amount of money you are willing to risk on one specific trade. Let me explain that a little bit further. So, anytime you place a trade in markets, you are exposing yourself to a specific amount of risk. This amount of risk is determined by 2 factors. Those 2 factors are the amount of pips down to your stop loss order. I always suggest using stop losses. I'll explain that on number 2, but down to your stop loss order, the amount of pips plus your position size. These are the 2 things that are going to determine how much money you have at risk at any one specific time on a specific trade. Again, I'll go over that really quickly. Our risk, the amount of money we are accepting as a possible loss on a trade, is known as risk tolerance. The risk on a specific trade is determined by the amount of pips down to our stop loss order and our position size. This number, whatever it is for you, again, is called risk tolerance, and we need that number down to your stop loss to be less than or equal to your specific risk tolerance. You never want to risk more than you are comfortable losing on a specific trade. As traders, we all lose money at times. We all lose trades at times. That's just a part of trading. Even professional traders have plenty of losses. So what risk tolerance is a number that we are comfortable losing, an amount of money or a percentage of our account we are comfortable losing when we have those inevitable losses. So just to give you an example of this, I personally use percentages instead of just whole numbers as dollars. And let's just, for easy math, assume that I had a 10K account. Okay, so I have a $10,000 account. For me personally, this is in no way a suggestion for you. Your own risk tolerance will be determined by you and you alone. There's no way for anyone to tell you what you are comfortable risking. But for me, it's between 1% and 3% of my total account value. Again, if I had a 10K account, that would mean that for every trade I placed while my account was at $10,000, I would be risking between $100 and $300. So my risk right here, right? If I'm risking between 1 and 3% of my 10K account, is going to be between $100 and $300. So for me personally, this is my risk tolerance, and every single trade that I place needs to be at or under this risk tolerance. My risk tolerance being $300 on a $10,000 account, or 3% of my total account value is always my risk tolerance. So as long as my risk on a specific trade, determined by the pips down to my stop loss and my position size, keeps me at under a $300 risk on a $10,000 account, or 3% of my total account value, then I am following my risk tolerance rules. Don't let this confuse you if you're new. I'm going to show you a very fast and very simple way to calculate the amount of money you are risking per trade momentarily. And what this does is keeps us from letting emotions get in the way. If you're risking more than you're willing to lose on a specific trade, or God forbid, you're not using a stop loss at all, so your risk is unlimited, what happens is emotions tend to control the outcome of those trades. If you're not using a stop loss at all, essentially, you'll get out of that trade whenever you are so uncomfortable that you cannot take it anymore. And if you are using a stop loss, but you're risking more than you're comfortable with, more than what your risk tolerance allows, then what will happen is you'll end up moving that stop loss down because you're so uncomfortable with losing, or you'll get out of the trade before a logical area to get out where your stop loss is because you're already losing too much money. Either way, what you'll be doing is trading based on emotions, which is a great way to blow your account and a terrible way to try to become a professional and profitable trader. You'll never be consistently profitable if you're trading based on emotions. So understanding and implementing risk tolerance into your risk management plan is one of the main ways we disregard those emotions, because we're only trading with a risk that we are comfortable with. Let's move on now to number 2, where I'll explain what stop losses are and how to use them correctly. Stop loss orders are extremely simple. What we're doing with a stop loss, let's say we have a buy trade and you bought in here at this blue line. What you want to do at that point is pick a logical place in the market where you know you're wrong about a trade. So let's say we bought in here. A logical place would be below the previous swing low for us to go, okay, well, if we're coming all the way down here, getting below this previous swing low, we're probably not going to end up making new highs. So that would be a logical place to place an order. So we bought in here. We may decide to put a stop loss right below this swing low. So all we need in order to place a stop loss order is to know the price of that. So I just put a horizontal line on the chart and it shows the price of 0.8789. This would be the point, I know I'm wrong, a logical place to place a stop loss order. So in order to do that, any trading platform should give you the option of placing a stop loss order. If your brokerage doesn't allow you to do that, you probably need to change brokers. But in order to do that, it's very simple. Go to your order form, wherever that is. Here's mine. You're going to want to place your trade, whatever the trade is. Let's pretend it's a market order. You're going to want to choose to place a stop loss, and you're either going to want to place that stop loss based on the amount of pips, which you can see whenever I hover over this red thing. It says 72 pips here. So the amount of pips would be 72 in this case. Or you can do it by price. As you can see right here, price, I can do the stop loss as 0.8789, 0.8789. So now if I was to press buy, what would automatically happen is I would open up a buy trade and automatically I would have a stop loss order in place right here at our red line. That's as easy as it is to place a stop loss order, so nothing too complicated there. And for a short trade, it would be exactly the opposite. If you were going short or selling the market, you would want your stop loss to be above price in a logical area that makes sense to tell you you're wrong about a trade, and it'll be a certain amount of pips away, right? Well,